and we're knocking them out back to back. You've heard this, right? This Jay-Z and Nas talking about angel investing in VC on a new song they made.
There's a guy called Dan Runcie, I think that's how you pronounce his name, who runs a newsletter called Trapital.
Wonderful name.
It's an amazing name. And what he does is he breaks down what goes on in the hip-hop world from like a business perspective. And then he talks about Khaled, DJ Khaled's approach to music. And it's fucking nuts. Like, DJ Khaled basically gets the biggest and best names on every single song because, one, he's decentralized the method. No one needs to come to a studio anymore. They can just hop in any studio and send in the shit and he'll get his team of engineers to fix it. And then second, he is a PR machine. The guy just, I don't know how he does it, but he runs social. Like he's the biggest guy on Snapchat, Instagram, all of that stuff.
People criticize Khaled for being the annoying, stupid guy. He is actually one of the smartest human beings on the planet because everything he does, he's an act. You are actually the stupid ones because you think that's the real him. He's the goat and the king of marketing and branding, and he knows what he's doing and pulling the strings and bringing people together. It's all an act, and he's really good at it.
What he also does really well is he has two sons, right? He puts his two sons as executive producers on the album. Why? And I think Dan doesn't pick up on this, but why I think it is because it means it's tax-free income for his kids in perpetuity, right?
His kids are 1 and 3, 1 and 4.
Yeah.
They're kids.
So yeah, the guy's winning my eyes. But the thing is,
I can't judge.
I listened to the song. The Nas and Jay-Z's verses are actually trash. Like they're some of the worst stuff they do. And Dan picks up on this. He's like, yeah, you never get great quality on a Khaled track, but the beats are really good and the production is really, really high value. But he gets people excited because he gets unbelievable features on it.
I'm actually a fan of both, and I agree. I was a little bit disappointed. And you can actually tell that it's been recorded in different studios and they just send it over to Khaled because when it jumps to like the next song, the volume is just like blowing my ears. I'm like, dude, some mixing and mastering would do. We've got a more professional setup here with our Blue Yeti USB microphones. Anyway, basically their lyrics are talking about angel investing and making money in Silicon Valley. And I was like, this is when you just know we've reached peak herd mentality and groupthink. Because I mean, nature of the game for these guys, there's probably no better investment. You've got a wad of cash and you spray and pray, dartboard analogy, throw 100 angel investments, 1 or 2 of them will make up for the losses on the rest and asymmetric returns. So kudos to them that they've got the cash to throw, but not kudos to anyone who likes to make angel investing sound like anything technical. You're simply betting on a team. That's it. There's no rocket science to it. Anyway, I think the first thing I'm going to dive into quickly, I'd like to get your thoughts on today, is Bitcoin. And it's probably against what our brand stands for, but we're going to cover it anyway because we know you dopamine-seeking junkies love to hear about this stuff. So, the two people that I genuinely admire and respect the most have come out and pretty much said the same thing. The two GOATs. If you said to me right now, you can pick 2 mentors alive, forget alive, dead or alive, you can pick 2 mentors, I would say Charlie Munger and Nassim Taleb. And the two guys have come out with statements. Taleb has said, I'll summarize, he ripped into Bitcoin as a gimmick that it's too volatile to be a currency and an unsafe hedge against inflation. Basically, there's no connection between inflation and Bitcoin. And he also said it's an open Ponzi and a failed currency. I don't need to go on anymore. I mean, he's ripped into it. And then we had Uncle Charlie Munger, who at the Berkshire Hathaway annual meeting last week said he called Bitcoin disgusting and contrary to the interests of civilization. I don't welcome a currency that's so useful to kidnappers and extortionists and so forth. Nor do I like just shuffling out of your extra billions of dollars to somebody who just invented a new financial product out of thin air. And he criticized the extreme volatility and lack of regulation. Now, I love these guys. They make some theoretic, and when you look at it from a rational standpoint and you zoom out, yeah, they make some fair points. But then also on the other flip side of things, if we're trying to put our critical thinking hats on, we know that Bitcoin blockchain, it's all a byproduct of math. It's proof of work, it's mathematics, it's computer science, it's binary. Therefore, it must be the truth, right? Because then on the flip side, the reason Bitcoin gets such a bad name is because 99.9% of those buying it, or any crypto, herd mentality, groupthink, FOMO, low IQ, idiots just jumping in to get quick returns because they don't understand the true power of compounding. But you have the 0.1%, such as those who actually built these products, who understand the true technology behind it, the nerd of nerds who you never hear or see online. Fortunately, one of them you do hear and see online, who is Balaji Srinivasan, I believe, who one of the technical titans of Silicon Valley, ex-CTO of Coinbase, undergrad to master's PhD electrical engineering, all from Stanford, previous partner at Andreessen Horowitz, I believe, bunch of stuff he does, huge accolades, and he really understands the technology. He did a 4-hour episode on Tim Ferriss recently, which we'll link in the show notes, you should listen to. He really logically breaks down why he's so bullish and supportive of the crypto revolution, the blockchain revolution, and everything. So share with us some of his thoughts, and then we'll discuss the two sides of the argument, because you've got these two camps of very smart, logical, and rational people arguing against each other. So what does Balaji say?
The key component that is being argued around, the key element of economic theory that's being tested between the camp for and the camp against Bitcoin is inflation. Right? So Taleb is saying you cannot hedge against inflation with Bitcoin. Why? Because Bitcoin doesn't give you returns. It's too volatile to be used as a currency currently. He does concede that it's a beautiful technological innovation and that it's got wonderful mathematical systems behind it. But what he does say is that given its volatility, it can't be a hedge against inflation today. But also, if you want to hedge against inflation, go and buy something that gives you value, that gives you returns over a period of time. He says, go and buy land. Now, Balaji comes out and says, half of the stuff he says I hardly ever understand, but he basically says how best to inflation-proof long-term USD denominated contracts. CPI isn't a trustworthy denominator. And if you know economics, like simple economic theory, you know that that's accurate, right? But he says Bitcoin works best if the counterparty buys the total amount up front, which they may resist, perhaps denominating CHF or a better managed, less printed foreign fiat currency. What he's basically saying is that it's very easy to say it's not a great hedge against inflation, but essentially you're using the USD as a currency that is currently under significant pressure, downward pressure, because the government has been printing so much money that you cannot just use the USD as a method of comparison. The CPI index is so poor in and of itself that you have to find something else. I don't know the technicalities behind it in too much detail, but my understanding is that Balaji is saying that in the longer term, beyond the problematic nature of the price of Bitcoin, put the cryptocurrency aside, the fundamental aspect of the technology will yield benefits against inflation in the long term.
I agree with Taleb in the sense that, for example, land or a company will produce dividends and cash flow. And I also understand Balaji's point of view. The one thing that I like to share from my experience of is, and these are the people who are not really necessarily shouting about it online, because these are the true brains, these are the nerd of nerds sitting there, they understand the technology. Any of these people that I call and speak to in the industry, they tell me that the technology behind Bitcoin is not impressive because it was initially created as a currency, a digital currency, right? But the problem is, due to now the sort of speed of transactions and many other complications, basically it's not performing as it was intended to do so because of the increasing number of blocks or whatever. I'm not going to get too technical with it. But because of more people making transactions, it's therefore slowed the thing down. The fees are going up, I believe. The speed is going down. So what does it become? It's become a store of value. It's no longer a digital currency. So other cryptos are popping up to become this sort of digital currency, but Bitcoin has become this store of value. Now, if you want a store of value, there is gold. What's wrong with gold? Well, people criticize gold for its own reasons as well. What does all of this mean? What are my views on it from someone who's spent a little time in the industry previously. It is what I say again and again, like a broken record. Any single person should put in between 1 and 10% of their portfolio towards speculative assets, speculation. Money you're willing to lose, money you're willing to never see again. I think Nassim Taleb actually talks about this. He talks about this barbell analogy. He has this barbell analogy for many things in life, but he says for your investments, 90% of it should be in something very safe. For me, I mean, I'd consider S&P 500 index. On the other end, 10% of it should be something where it provides asymmetric return. So for me, that would be the 10% is angel investing, it's crypto, and it's anything where you're pretty likely to lose the money because it's speculation. Because when you're buying Bitcoin and all of this stupidity I'm seeing of institutions and people pouring in, even Jamie Dimon used to doubt it and now he's on the bandwagon, it's solely because of their interest of getting more money. Not that they need more money, but it's in the interest of making more money and getting rich and more power. Them buying Bitcoin is FOMO. Why do they have FOMO? Because they think the price of it is going to go up. Well, what's the price increase based on? It's based on people's perception. You selling a Bitcoin to me is me thinking the price is going to go up and you thinking, oh, I've got the returns I need, or the price is going to go down and you're going to sell. So it's solely based on speculation. And what Taleb is saying is, hey, stupid idiots, the price should be Finance 101. When you discount the future cash flows, it should be based on what is this going to pay you? A property pays you rent. A stock pays you dividends. This is paying you nothing. You're speculating. It doesn't produce anything. So it's failed as a digital currency. It doesn't pay any dividends or cash flow or anything. It's literally just become a clunky store of value. Now, people are saying volatility has decreased because more institutions have poured in. But why have more institutions poured in? Because they're speculating. And for them, these institutions have billions and billions. For them, it's just a drop in the ocean, really. It's the part of their speculative portion of their portfolio. And human beings, the general public, should do the same, retail investors. I think Chamath said this many years ago on CNBC before all this craze. He said, for every $100 you have, put one in Bitcoin. That's it. Yeah. I agree long term. Long term, I'm very bullish on blockchain technology in the sense that it solves for a lot of real world problems and issues we've been facing. The much needed decentralization in many aspects and functions of the business world and just life in general. However, it's too soon. The plumbing and architecture is not there yet. The smart engineers are not all flocking to blockchain. They're still sort of jumping over to machine learning and AI. So I think we're years away from advancements in blockchain. Long-term bullish on blockchain, yes. Long-term bullish on crypto, not necessarily. I still see it as a speculative asset. Unlike Buffett and Munger, where you're reading 500 pages of annual reports a day and the sit on your ass philosophy, which we're going to link it in the show notes. John Todor Investments, guy I connected with this week, has a great article on this philosophy of sitting on your ass. He lives by the Buffett and Munger philosophy of you just make 1 to 3 decisions a year, investment decisions, and that's it. The rest of the year is just spent reading, researching to make those investments. So you're within your circle of competence, as the Berkshire guys say, and you make the bets. And in 60 years, 50 years, that'll materialize to something very lucrative, or in 30 years, however long, because it compounds. You've bet on the long term. You understand the deep foundational pillars of the company. You put trust in the management and so on and so forth. So that's what I think. A long-winded answer of it's speculation. I'm sick and tired of all the bullshit and nonsense online.
Have fun staying poor. You're going to stay poor. I'll see you later. I'm going to go put all my money into crypto. 80%.
You can pick me up in your Ferrari, Lambo and 20 fleet supercar collection.
Thank you. But yeah, I think yeah. Look, the key thing for me, the thing that really hit home for me to wrap all of this up is have fun staying poor is a meme, but that it's actually grown to become more than a meme, and it's actually hilarious that people actually think like this, especially in a bull market. But secondly, it's really interesting that although Balaji is really into the technology, really understands it, really believes in the value of that technology, the thing that really hits home is that with other technologies, anything can come. With the pace that we've been moving in this industry, the exponential pace, any other technology can come and take over crypto. You don't necessarily need crypto as a way of payment. Facilitating.
It's not anti-fragile.
It's
To an extent it can be, but
it's not fully anti-fragile. I'll agree with that. But blockchain technology is just a ledger technology. Like, there will be other technologies that emerge that could potentially either leverage it and build on it, or that could essentially take over it.
I'm tired. I don't have anything else to say.
Let's stop talking about Bitcoin because it gives you heart palpitations. Let's talk about something more interesting, which is, we're based in London, European tech, the venture space and the investments in European tech has essentially reached an all-time high. Crunchbase News did an article, we'll link in the show notes, but I'll bring it up on screen for those watching on YouTube. European venture reaches all-time high in the first quarter of 2021. This is by dollar volume, and its year-on-year changes at 130%. And the quarter-on-quarter change, so from Q4 20 to Q1 21, there was an 83% increase in European venture dollar volume. That means essentially your volume of deals times the price of the deal, times the amount being funded. Not necessarily the number of deals. I'll let you come onto that in a second. But that's majority been driven by late stage. So not growth stage, not early stage, not angel seed, but late stage. I'll pull up the chart, you can see what I mean. What are your thoughts on this?
If we're looking at seed and angel investment, which to me is really the most important part, we'll move on to the other later stage funding soon, but to me the most important part of the innovation ecosystem within Europe is the pre-seed, seed, angel rounds. Why? Well, as I've mentioned before, the issue in Europe versus, and a lot of our listeners almost half are US based, Europe has multiple issues. One, there's a dinosaur mentality. There's literally cases and stories of like a German VC needing 25 wet signatures to do a small round of pre-seed. Whereas in the US, people do humongous Series A or whatever deals through, I don't know, like a hello sign. That's one example of millions.
Yeah.
Of how backdated the European mentality is. Everything's just so... It's just so old school. They lack flexibility. That's first issue. Second issue is regulation. Third issue is the fragmentation of the market, multiple jurisdictions. And going back to the mentality aspect, another part of that is historically, we haven't seen any of the exits that you'd see in the US. We haven't seen any of the multiples or the rounds, etc., etc. And acquisitions have been pretty rare. They've happened, but nothing in comparison to the US. Pull up the chart here. Total dollars invested in Europe in Q1 2021 has gone up compared to all previous quarters. So total dollars invested has gone up. However, the number of deals has reduced. So what we're seeing is more money is going to less companies. What is the reason for this? I think what we're seeing in Europe, and this is from my experience firsthand being in the industry, we're seeing more investors pour in, more people want to be investing in tech, and people are saying, yeah, it's the time to start a company. It's easier than ever. There's more capital floating around than ever before. Not necessarily true, because investors now they're getting smarter. We'll get onto Tiger Global shortly, which is a complete different story. Some investors are utilizing a lot of data, and people are getting smarter with their investing. That's one side of it. The other reason for it is, did you go to Oxbridge? Did you go to INSEAD for an MBA? Did you work at McKinsey? Tick, 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 tick. I'm not going to name names. I know people who I literally have said it to my face. Yes, these stupid investors invested in us because I have this insert credential. They worked at this big company or this big consulting firm, or they did some sort of PhD in something particular where the VCs are like, oh wow, this guy must really know a lot about this particular field. But really, the founder laughs and they tell me I don't know a thing. But they secure the funding. They hire people who kind of know what they're doing. It's broken. Europe's broken. A lot to learn from the US. A few smart investors in Europe who are they're doing sort of, more people are moving towards the Tiger model of outsourcing your due diligence and analysis and utilizing data and a bunch of other things all at once and moving super fast. And then you've got a bunch of people, which is the majority, who are still stupid in the dinosaur age and investing based on credentials, and they won't last. They'll get squeezed out long term. VC is sort of a 7 to 10 year game, and we won't see these VCs around in 7 to 10 years once we see the returns of the superior VCs materialize.
The interesting thing from the data in this Crunchbase piece, I think you picked on a little bit, is the number of active investors by new versus existing portfolios. So essentially VCs that are putting in money into companies they already have investments in versus those that are new and coming to them. And it harps back to the point around a lack of number of deals, even though there is a volume of deals in the seed and early stage investment piece. The majority of the European funds are putting money into new portfolio, and what we're also seeing is a move in sort of an entryway for a lot of the US funds into Europe. So even though they have all these problems, all of these structural issues around investment that exist in Europe, you're getting a lot of US companies, for example, Google's venture capital firm Axel, and then you've also got Tiger. And well, look, Tiger's everywhere, and that's a separate point, but there seems to be a move towards new portfolio, which is great, but the number of deals that are happening in that new portfolio is low. And what's also really interesting is that the acquisitions of these companies is going up. So there's a bit of a juxtaposition in the title of this article, even though it's presenting the facts, in that yes, we're at an all-time high. Yes, everything looks dandy, but actually the structural underpinnings of European technology companies and investing in Europe is holding back what further potential could exist. And I don't think this is the downfall of Europe. I think Europe has beautiful historical context and innate knowledge that the rest of the world lacks, based a lot of it around the development of its history and the fundamentals of a lot of the businesses that have been around for millennia, hundreds of years in these countries. So you have a Lindiness to European companies, which is great. But what you risk now doing is by providing too much incompetence really at the management level of Europe, if you want to call it that, at the political level of investing, that you could risk these European countries falling behind. We actually did an interview with Sean Seaton Rogers, who's a European VC. He was on the Midas list for Europe in 2020. Ex-Benchmark, really cool guy, has an amazing sneaker collection. Check it out if you want to see what sneakers he thinks are the most valuable and what he has in his collection. But he talked about Europe as being actually a sleeping giant when it comes to this market, because the intellectual capital that exists within businesses in Europe has not been fundamentally tapped into. And he gave the examples of fashion tech, which is still to grow really, but companies like Farfetch really blowing other companies out of the water and really taking over this market with a massive moat. But then also companies like Spotify with music and obviously the heritage that Europe has in music. So it's not all doom and gloom, but articles like that sometimes gloss over the structural issues that you mentioned. And I think that needs to come out more in European venture.
Touching on Tiger very quickly and what people can learn from Tiger Global, Everett Randall of Founders Fund published the article which went pretty viral, called Playing Different Games. We'll link it below on a Substack. And he's discussing how and why Tiger is taking over. From my perspective, I think they've just started. And I think they'll be top of that pretty soon. And they'll be leading European tech investment. Why am I excited about Tiger doing this? Well, historically, VC was already, in my view, and one of the reasons we started this whole brand, as the name suggests, VC was already broken in the US in many aspects, let alone in Europe for the reasons I mentioned a few minutes ago and the whole mentality around just being in the dinosaur age. Now, why is this good that you've got players like Tiger, even Co2, few others crossing the pond, playing this game in the European space? Because it will force these dinosaur European VCs to wake up. They either have to fix their act or they're out the window. Credit to Everett Randall of Founders Fund. If you can throw up the image, the comparison between VC firms. On one end, which in this image he gives an example of Benchmark, but replace Benchmark with any other tier 1 VC, your Sequoias, your Andreessen Horowitz, your Axels, maybe one or two more, your Coastler, Founders Fund, etc. That's pretty much about it. Maybe one or two others I've missed. You'll see the analysis on the left side. What do these traditional tier 1 VCs offer? Well, it says low velocity, higher IRR over MOM. Main advantages are signaling, building a board of directors. It is expensive capital due to the level of dilution that's going to happen. It's best for early founders looking for validation and help, and just this sort of herd mentality and FOMO we've seen. Any of these guys invest, your follow-on rounds will be much easier. On the right side, you have Tiger Global, who are high velocity, low IRR MOM. Main advantages are speed, cost of capital. Disadvantages, no signaling, which I think is actually not a disadvantage. Best for late stage businesses that need no help. And what Everett has done in this image, he's compared the left side, your tier 1 VCs such as Benchmark and Sequoias, to Tiffany & Co. And then the right side, he's compared Tiger Global to Walmart, just being the giants. And the logo under Walmart, of course, the slogan being save money, live better. In the middle, you have the dead zone, the rest in peace, which he refers to as the JC Penney's. And I'm sure a lot of the US listeners will understand this example a lot better than European. But the dead zone is all other VCs. Anyone else playing the VC game, and we're seeing this. Kids reach out to us through Minority in Tech, the community we run, saying, how do I become a VC? I want to become a VC. What about VC as a career path? Which is a different episode in itself, which we always shut down. We're like, just go and pick up some damn technical skills and work on tough problems first, develop rare and valuable skills, ML, engineering, computational biology, etc., climate tech, life sciences. Become a deep expert, technical knowledge of one particular area. People are not developing these skills. They want to become VCs. Well, my friend, if you want to become a VC, this will be your future. This dead zone is where most VCs go. Very few become the tier 1 VCs. If you're there, kudos. Very few become the right side, the tigers. And most go and end up in the middle, the dead zone, the JC Penney style, which is something that, people know about. They're not really going to use it. If others are not investing in the other two sides, then you should be pretty concerned.
I think they're waking up as it is. I think the market, look, if volume's increasing, at some level there is a shift in this market and across the world to enter the European space, and it will change. It's just a slow coach.
I think that's about it. This is two topics that have been on our mind. People talk about a lot. They ask us around these topics on Bitcoin, European VC, Bitcoin, European. Here you go. Here's the long-winded answer. It's probably the most boring episode we've done, but hey, people wanted to answer this, hear about these things. Here you go.
Listeners can submit questions. I'll put the link in the notes below. We can talk about anything you guys want us to pick up on.
Yeah, that's about it. Continuing this new format, I'm really enjoying it. Me and you talking rather than inviting guests on. I'd rather me and you shoot the shit. This is just like us catching up, but with a camera on anyway, and the mics. So rationalvc.com. Go subscribe to our Rational Letter monthly memo. Over 1,000 founders, VCs, investment professionals subscribe. If you don't want to subscribe, fine. You can go read some for free and make your mind up. You can also listen to any of these on Apple and Spotify if you don't want to watch us on YouTube. That's about it. Anything else, Iman?
That's it. I'm sick and tired of your face.
Peace.
Peace.